Hello, and welcome to this special edition of CBTV. I'm Matt Rettick, the host of Checks and Balances TV. Today I'll be presenting our newest installment in our Truth About series, and it's on the truth about average stock market returns. If you ever listened to a radio talk show on investments or read a popular consumer financial magazine or even picked up a newspaper and opened up the financial section, it's likely that you've read or heard about something called the average rate of return of the stock market. But what does that really mean? And should a prudent person really trust this type of statistic when considering investing in the stock market? Let's find out. By the way, you can download our free report on the truth about average stock market returns in the download section of our website. One of the most well-known and well-respected financial experts in the country is a professor of finance from Yale University named Roger Ibbotson. He and a colleague of his published the Standard Reference for Information on Investment Returns titled Stocks, Bonds, Bills, and Inflation, also known as SBBI. And it's updated on an annual basis. Now, according to the SBBI's latest report, the average annual rate of return for large cap stocks is approximately 11.82% from 1926 to the end of 2012. And by the way, large cap stocks simply mean, for the most part, the biggest companies in the U.S. stock market. So if the most respected standard reference for investment returns states that the average annual return is 11.82%, who are we to disagree? Well, we're your source for unbiased financial truth. So let's now take a look at how this math really works, and we're going to keep it very, very simple. Let's just suppose that you invested $100,000 into a mutual fund, and in the first year you made a 100% return. That means at the end of the first year, your account is worth how much? That's right, $200,000. Awesome, great news, right? But let's just say in the second year, the mutual fund loses 50%. Now, if you lose half of your $200,000, where are you? Right back where you were and where you started 2 years ago with $100,000, right? So what is your average rate of return then? Well, it's got to be zero, right? 0%. It's just common sense. But let's ignore common sense for a minute and just look at the annual average returns each year. So in year one, you gained 100%, and year two, you lost 50%. So in order to get an average, you simply add and then subtract the two numbers and then divide by the 2 years you're looking at. So what does it mean? It means 100% minus 50% equals 50%, and 50% divided by 2 years equals 25% per year. So the SBBI book would then report that the average return for those 2 years was 25% per year. And to make matters worse, they're technically right using average rates of return. Ridiculous, isn't it? Again, for even more information, download our free report on the truth about average stock market returns in the download section of our website. Okay, now I want to talk about the average arithmetic return versus the average geometric or compounded return, or you might have heard annualized return. Now, I understand this sounds too much like math, but pay close attention here. There's a critical difference between these two return methods of calculation. One's fictitious and one's real. Now, the arithmetic average return is found by adding up the annual returns for each year over time and then dividing them by the number of years you're tracking. So when Ibbotson publishes their annual SBBI reference guide, they look at each annual return for each year starting from December 31st, 1925, all the way through the end of 2012, being December 31st of 2012, and then they divide by 87 years. The result is 11.82% per year. So if Ibbotson and other talking heads are right, that means that if you started with $100 on December 31st of 1925 and you left it there fully invested for 87 years, that you should end up with, are you ready for this? $1,664,161. Sounds great, doesn't it? There's just one big problem. Their math is seriously flawed. So now I'm going to reveal to you what I call the real rate of return, the geometric return, or compounded return, or really what they call the annualized average. And here's how it works. On December 20 of 1925, the S&P 500 closed at 12.46 points. It closed 87 years later on December 31st, 2012 at 1,426 points. So very simply, using a financial calculator, I can determine exactly what interest rate was needed in order for 12.46 to grow to 1,426 points over 87 years. And let me share with you what the answer is. You ready for this? It's 5.60% average annualized return. That's right, 5.60%. So using this correct method of calculation, the true return over time, if you had invested $100 in the S&P 500 in December of 1925 and earned an average rate of return, an annualized return rather, of 5.60% for 87 years, what would your $100 be worth? Now this is of course not including dividends from any of the stocks. Well again, a financial calculator at $100 over 5.60% over 87 years is, are you ready? $11,448. That's not a typographical error. Your $100 grew to only $11,448. So what happened? Where did your $1.6 million go? Well, the answer is you never had it to begin with, because that isn't the way money works. And that's the big difference between Wall Street math and the balanced financial truth. Now, when I talked about the true compounded annual rate of return of the S&P 500 from 1926 through 2012, I made a point of saying that this return did not count dividends. Now, while dividends vary by company as well as by time period, in general, most knowledgeable financial people agree that dividends should add about 2 percentage points to your returns over time. So that means that the S&P 500 really averaged about 5.60% per year. When you add in dividends, you'd most likely end up with a compounded average annual return of roughly 7.6% over the long haul, which is still a far cry from the 11.8% that most stockbrokers promote today. And there's another very important point I want to make here, and that's simply this. Many television and radio talking heads today, as well as other so-called financial experts, like to talk about the long haul and often use the 70 to 80 year long time periods to come up with these what I call so-called and inaccurate average returns. But how many people really have 70 to 80 years to let their money sit and compound? Well, the answer is nobody has anywhere near that long. So be very cautious when you hear brokers or financial advisors discussing the average return over the stock market over 70 or 80 years. It just doesn't apply to you and your nest egg. And remember, for even more information, download our free report on the truth about average stock market returns in the download section of our website. The key here is to really know and understand that money is not math. Simple arithmetic is simple, but when it comes to your money, it doesn't work that way. Counting on the average rate of return, even if you use the correct real average, is a dangerous game, because these averages are based on unrealistically long periods of time that you almost certainly do not have. So be aware of what average rates of return in the stock market really mean, and don't be a gullible consumer and believe everything a stockbroker, financial planner, advisor, television or radio financial guru, or mutual fund company tells you. Become what I call a 21st century investor. Ask the tough questions, do your research, and hold your advisor accountable. As a final thought, if you're going to purchase any type of investment product in the future, consider working with a competent professional financial advisor, someone who can help you navigate through all the different options out there today. And if you're in need of someone like this to work with, call us toll-free at 877-575-2288. Again, 877-575-CBTV. And we'll have one of our true financial advisors get in touch with you to help you navigate through all of the options out there today. Also, be sure to request our free report on the truth about average stock market returns by logging onto our website and downloading this in-depth report. I want to arm you with the truth about real returns versus imaginary returns. And as a quick reminder, be sure to watch a new edition of Checks and Balances TV every week on Friday at 4 p.m. Eastern Standard Time for the balanced truth you need to financially succeed. I'm Matt Rettick, the host of Checks and Balances TV. Thanks for watching this special edition of CBTV. And finally, remember that you can become financially independent. You just need confidence and determination. Until next time, dump debt, invest wisely, believe in yourself, and make it happen.